if people in communities across the nation don't have access to the capital to be able to start a business, that limits how big the US economy can get. And so we as a country have been shooting ourselves in the foot.
This episode is presented by our friends at Front Finance. Hello, everyone. I'm here today with Brandon Andrews. He is a serial entrepreneur and casting director of ABC's hit reality show Shark Tank. He is leading a nationwide casting tour focused on bringing more diverse voices and ideas to Shark Tank and has been named a Global Innovation Fellow by the U.S. Department of State. Brandon is on a mission to bring capital and resources to diverse entrepreneurs. Welcome, Brandon, to The Confident Investor.
Well, hey, thank you so much for having me. Excited for the conversation and excited to get more folks that are listening the education and information they need to make some good financial decisions. Yeah.
Brandon, I know you don't come from a traditional business background, and a lot of people feel like they can't get their foot in the door when they don't have the right sorts of access. So tell us a little bit about your background and how you got to the role today and how it's shaping the work that you're doing.
Yeah, thanks. Thanks again for having me. And I say to people, what do you think an investor looks like? And I think there's a certain kind of person that maybe comes to mind, but I think everyone, the answer to that question should be look in the mirror, look at yourself, because that's what an investor, that's what a business person certainly can look like. So I did grow up in a small town, South Alabama. My grandmother raised me there. She was wonderful, but not a business person at all. She was a teacher for about 40 years and was a pillar in that community. But I really didn't have any experience with entrepreneurship. I had heard of being a business person, but I didn't know what business people did or how to become one. And I certainly hadn't wrapped my mind around having my own business. But I think the fact that I've had some success in the business world means that anyone, no matter where you're from, no matter what kind of family you come from, no matter what region, zip code, state, locality you come from, you can learn some principles that will help you to make good decisions in terms of starting businesses or investing in them. So if I can do it, certainly anybody else out there can too.
What was that process like for you actually getting your foot in the door?
Yeah, and growing up, I just because I wasn't exposed to business, I wasn't really interested in business. I didn't even know to aspire to have a business career, quite frankly. And so I was focused on impact. I was focused on maybe government, engineering, were some things that I tossed around in my head as I was growing up and thinking about what I'd want to do eventually. The real change for me, I think, came during my time on Capitol Hill. So I grew up in Alabama, graduated high school in Florida, in Panama City, went to college in Oklahoma. And while I was there, I interned for a member of Congress for a couple of years. That experience led to me getting a paid internship in DC when I graduated and started out my career working in the US Senate. So I was there for the better part of 5 years. And part of my role on Capitol Hill was to vet proposals from companies that were coming in wanting to work with the government in some way. And so there were large and small companies. Sometimes they were grant giving organizations, sometimes they were educational institutions, but everybody had a project that they wanted to work on. They had something that they wanted to build. And seeing their work, seeing their projects really inspired me. And I said, hey, at some point, I'd love to be able to do this outside of government. I'd love to be able to take a look at projects and potentially allocate support or allocate funding for them, which is exactly what you do as an investor and exactly what I've been able to do in working with entrepreneurs over the years. And so it's not something that I had thought about really at all because I hadn't been exposed to it. But once I got exposed to it, it was so interesting to me, and I saw the positive impact that a lot of these companies were having because a lot of these companies were working on leading edge, trailing edge technology, and they were coming to Congress because to go through the usual procurement process in government very often takes years to do. And there were people, very often folks in the defense space, that needed what they were creating immediately. They needed it within months, not years. And so trying to figure out a way to get the warfighter, well, at that point, we were engaged in Iraq and Afghanistan, trying to get them what they needed really inspired me and showed me the power of using business and innovation to solve problems. And I haven't looked back since then.
This episode is presented by our friends at Front Finance. Are you looking for ways to boost your investing strategy? Check out Front. It's a free app that helps you make better investment decisions with their proprietary Fisco technology. It analyzes companies and stock data 24/7 and rates stocks with a single score, like a credit score for stocks. Connect your existing broker to get a complete portfolio analysis and daily personalized stock picks based on your preferences and existing investments. It's time to start investing with data, not your gut. Download Front for free at refer.front.org/Lisa. One of the things that you do on your job is, of course, meet thousands of entrepreneurs each year at Shark Tank casting calls. And
Yeah.
I imagine that access to capital is the primary concern for most of them.
Absolutely. It doesn't matter where I go. I've traveled this country top to bottom, East Coast, West Coast, big city, small town, everything in between. Unequivocally, I can say that that spark of innovation and that grit that you need to grow a business, those attributes exist everywhere. But I can also tell you that access to capital is absolutely the number one concern for people wherever we go. And so at our Shark Tank casting calls, will do a pitch prep session with the entrepreneurs before they pitch to the producers who are going to make a decision on their application for the show. And the conversation about the ask is always the most poignant. It always gets people sitting up in their seats. Sometimes our casting calls are really early in the morning. We have to start them early to be able to get enough people through the casting process. Sometimes people haven't had their coffee, but when you start talking about money, you start talking about capital, you start talking about an investment in their business, people perk up immediately. It's like instant coffee, straight into their veins versus them having to wait in line to try to get a cup at some of the venues that we're at. It's always the number one concern, and fortunately, over the past few years, we've seen some policy changes that are now bringing access to capital to a wider range of entrepreneurs, to a wider range of people, and also bringing opportunities to invest in those businesses to a wider range of people, which I think is really helpful. The reality is we get a lot of applications for Shark Tank, 40,000 plus in any given season, and most of them aren't going to make it on the show. And so I want to make sure that those entrepreneurs that don't make it on the show, that don't move forward in the process, but still have a really innovative company, a really good idea, that still have that spark, still have that grit, that they have the resources they need to be able to build their businesses. And that's a lot of the work that I focus on when I'm not doing casting calls.
Mm. Yeah, I definitely want to get into the ways in which we're bringing on more diverse investors. But just to finish off the thought around Shark Tank and the entrepreneurs, what are some of the big mistakes you see entrepreneurs making when they're doing that pitch?
Yeah, well, here's my general guidance that I give to entrepreneurs when they're pitching, and this is helpful for Shark Tank or whether you're doing virtual pitch competition in this COVID era, or you're pitching to customers, or you're pitching to potential business partners. Hopefully this can be helpful anywhere. I break down the pitch. I say we're always looking for people that are passionate. Passion can come out in a number of ways. Sometimes it can be people coming onto the show and doing backflips and cartwheels and breathing fire and all those kinds of things to differentiate their business from everybody else's. But that's not everybody's personality. Passion can also be the story that you tell. So saying, hey, I had this problem. I've now created a solution for it, and I want to build a business to help other people who have this same issue. Maybe my family member had this issue. Maybe I'm using my great grandmother's cookie recipe, and now I've added a special dash of cardamom or cinnamon or something to it, and I'm dedicating a percentage of the sales to her memory. However you want to describe passion for yourself, make sure that that comes through when you're pitching. It's really important. The next pieces are really structural: problem, solution, market opportunity, traction, and make your ask. Believe it or not, one of the biggest issues we have is entrepreneurs actually not asking for money or not asking for it confidently. It's very easy to tell when an entrepreneur has actually thought out, hey, this is the amount of money that I need to get my business to the next level. This is the shark or the investor that I think can best help me get my business to the next level. And this is the amount of my business that I want to give up in exchange for this shark's assistance. There are entrepreneurs that we can tell have come into the casting process, knowing that they're exchanging value for value. And there's another set of entrepreneurs who are just unfamiliar with the process, or who just don't have the same level of confidence. And so I say to people, hey, look in the mirror and say, I'm valuable. And so therefore, whatever I'm creating in the business sense, in an innovation sense, is valuable. And when I'm stepping in front of investors, stepping in front of a bank, stepping in front of potential partners, I'm trading value for value. Sometimes I think because of the way Shark Tank is set up, you see the sharks in this dominant position and the entrepreneurs in this subordinate role. But the reality is, without the entrepreneurs, without what you're creating as an entrepreneur, the sharks' money is going to sit there. They're investing in the business, yes, because they're interested in the industry or the sector that you're working in, but ostensibly they're investing in it because they can get a better return than putting their money in the stock market, than putting it in a money market account, or than going after or real estate, or going after some of these other asset classes that they'll have access to. And so you have something special, and make sure that when you're making that ask, that you describe and present what you're building as something special, and that'll come through in the business. And then I think the last thing that's really important is, as you're talking about the business, talk about the community that you're building, because the community that you're building is going to help you get feedback immediately on what it is you're building, to make sure you're building something that customers want and not necessarily something that you want or that you think is cool. And of course, ultimately, that community that you build, whether it's online or offline, whatever it may be, they're going to be potential customers for you as you move forward and get your product into market. So those are some quick tips on pitching, and hopefully those will be helpful to you, whether you're potentially pitching to be on Shark Tank, or pitching in other spaces as well.
I love everything you said there about the confidence in yourself as an entrepreneur. And I think a lot of times, I've worked with many female entrepreneurs during my time building my previous company, and it was often this difficulty of walking into the room facing an uneven power dynamic that you mentioned, with the perception that the investor has so much more power. And that power dynamic has been created by this narrative that the investor is the one who has the power, and the entrepreneur for some reason is begging. And you can feel that energy. And one of the things that I think we're both aligned on is bringing on more diverse investors and empowering a different generation of investors who are focused on creating positive impact and profit as a double bottom line. And one of those things that is allowing this monumental shift in power has been the Jobs Act, Reg CF. So for those who are unfamiliar with that, I know you've been in close contact with these changes. Tell us first and foremost, what was the Jobs Act and how did that help shift more power into non-accredited investors? What are non-accredited versus accredited? So help us get up to speed on the basics.
Yeah, I absolutely agree that some of the problem is investors have grown up in a world where investors have been regarded in a certain way, where they've expected the power dynamic to be set with investors being in this dominant position and entrepreneurs being in a subordinate position. But the question that I have is, what kind of world could we have if we multiplied the amount of investors, if we brought in more diversity to the pipeline of investors? We would, I think, in turn have more respect for entrepreneurs and their businesses, investors that are looking to add value and not just cut a check, and also investors that understand the innovative solutions to problems that entrepreneurs are pitching that very often investors in the past just haven't understood because they don't share the life experience, because they don't have that diversity of experience on that side of the table. And so prior to the Jobs Act, which we'll talk about in a second, if you were not an accredited investor in the United States, you were not just unable to invest in a company because you didn't have enough money, you were literally legally barred from investing by the US government. So have you ever heard somebody say, hey, I would love to go back in time and invest in Facebook or invest in Apple. I wish I could have met Steve Jobs. I wish I could have met Bill Gates and invested in Microsoft back then because I could have put some money in and now I'd be rich. And the reality is, yes, you would be, because of the incredible outsized returns those companies have made for their investors over the years. However, you probably couldn't because you weren't an accredited investor. And so again, you'd be legally barred from investing. In 2020, to be an accredited investor, you as a single person have to make over $200,000 in consecutive years. As a couple, you have to make over $300,000 in consecutive years, or you have to have a net worth over $1 million, not including your primary place of residence. As you might imagine, that is a very small percentage of the US population that qualifies by either those income standards or those net worth standards. And there's a lot of people that would be considered wealthy who have a lot of equity in their home, in their primary residence, who won't qualify as an accredited investor because they don't own multiple properties or they don't own other assets outside of that one home. And so a very small percentage of the US population was making investment decisions. And I think we have to demystify this investment decision piece as well, because I think sometimes when people think investments, they think large sums of money, but they also think about things that don't impact them. But when we're talking about investments, we're talking about people, a small group of people choosing what's going to be on store shelves in 2 to 3 years. So think about everything that's on Target, everything that's on Walmart store shelves, everything that people are looking at e-commerce wise. Most of those companies, if they're in big retail, they've gotten some kind of capital injection. They've gotten some kind of investment at some point. And the people, again, pre-Jobs Act, that were making those decisions were people that didn't reflect the diversity of the country. And so a lot of communities have for years said, why don't I have products and services on store shelves? Why don't I have things that are available to me that actually speak to my needs, to what I want? A lot of it can be traced back to who's actually funding the companies, who's actually saying this company is going to get a shot to move forward and put their product on store shelves. this company is going to have a chance to put their app in the app store and this company isn't. If those people don't reflect the diversity of the nation, then we get solutions, then we get businesses that don't reflect the problems or the solutions that the nation actually needs moving forward. It reflects where the nation's been versus where we're going. And so because of that issue and a number of others, to include the fact that in terms of wealth creation, most of the wealth is created pre-IPO, so before a company is available on a public market. You mentioned Robinhood, so before you'd be able to buy the stock, um, there was a movement to provide investing opportunities, targeted investing opportunities to everyday people, to quote unquote Main Street investors. And so that's what the Jobs Act did. It was signed by President Obama in 2012 and allowed the Securities and Exchange Commission, which is the US government agency responsible for capital markets, to put together a set of rules to allow non-accredited investors, so everybody else, that 95% plus of the population that doesn't meet those high income and wealth standards, allow them to invest in startup companies and real estate as well, without in targeted ways. And so that was passed in 2012 and 2016. We saw Regulation CF, which you mentioned, regulation crowdfunding, become legal. And since then, millions of dollars have been invested in startup companies all across the nation. And for a lot of communities, there's this discussion about entrepreneurs having a friends and family round. And the conversation for decades has been, well, people from communities of color or women, et cetera, they don't have the capital in their communities to be able to do a friends and family round, to get that initial round of capital. The reality is that money has always been there. Nielsen comes out with their buying power reports, and they talk about the buying power in the Latinx community, the buying power in the Black community, the buying power in other communities around the nation every year. And those numbers are in the billions of dollars. So the funds are there, but because people in those communities weren't accredited investors, they didn't have the opportunity to invest in companies founded by, led by people that look like them and that are solving problems that impact them. And because of that, it has not only stopped innovation, it stopped the creation of wealth in a lot of communities, and it's also stifled, in my opinion, our economic ability as a nation because, and I'm not going to get too nerdy here, but economic dynamism is incredibly important for a healthy economy, and that's driven by new business formation. And so if people in communities across the nation don't have access to the capital to be able to start a business, that limits how big the US economy can get. And so we as a country have been shooting ourselves in the foot. We've been holding down our economic potential because we were reserving the right to invest in innovative companies to people that by a lot of standards already were doing pretty well and maybe didn't need special access to being able to invest. And so that's the quick background there. And there's been progress that's been made, but also some more changes that I think will make the process better in the future.
Yeah, I mean, I just want to highlight and for everyone listening just how monumental this shift is for historically oppressed and marginalized minority groups, entrepreneurs who have tried to start businesses where they just couldn't access those networks.
Mm-hmm.
Still to date, over 90% of venture capital investors are male. Only 2% of funding goes to women, 0.2% to women of color.
Mm-hmm.
And there's so many initiatives now to help empower those entrepreneurs. There's a lot of media attention, but I think at the end of the day, it's a much more almost long-term investment into changing the investor landscape. And so these changes through the SEC are really just really important for where the future is going. And
Definitely.
So we know that since 2016, there have been, from the last time I looked, over 500 million that has been invested via these equity crowdfunding portals. one big change that has happened with the SEC is previously startups were able to raise up to around 1.1 million from non-accredited investors on these portals, and they've just raised that cap to 5 million, which I expect to really shift the landscape in terms of driving forward even faster the types of entrepreneurs who will be attracted to equity crowdfunding as a legitimate source of capital. Because one source of pushback, especially in these traditional venture communities, is saying, oh, well, we don't want to invest in startups that have gone through these equity crowdfunding portals, which personally I think is a protection of power, because whenever power is shifting, people don't want to let go of it. But what's your take on these changes?
Yeah, I think the changes this year are evidence of two things. One, the fact that it's working. So you mentioned over 500 million invested since regulation crowdfunding was authorized by the SEC. That's real money going to real businesses that are creating real products and services, and that are also creating wealth, that are creating economic potential and economic opportunity in our nation. And so that evidence is what pushes the SEC to consider making additional changes. So a lot of companies wouldn't do a Reg CF campaign because they could only raise $1 million in a calendar year, in a 12-month period. Now, with the raise to 5 million, a lot of the more successful Reg CF issuers, or what they're called, can now continue to raise funds up to the full potential of their campaign. So I know personally a lot of founders that had to stop at that 1 million number because it is a federally regulated number that they had to stop at, whereas they could have continued to raise funds for their company and put their company in a better position, and also give more people from the community an opportunity to invest in the company and potentially participate in the upside. If that company raises at a higher valuation, exits, IPOs, et cetera, has some kind of liquidity event. And so these new rules are evidence that this crowd investing movement, this crowdfunding movement is working, but it's also evidence that the crowdfunding community has come together, because there are people, leaders in these portals that allow the crowdfunding transactions to happen, entrepreneurs themselves, policymakers that have been advocating for these changes. And so I tip my hat to Jay Clayton, who's the SEC chairman currently, and he's on his way out with this administration. But coming into his administration, he said, I want to create more opportunities for Main Street investors. I want to create more opportunities for everyday people. And I want to take a hard look at the accredited investor definition. I want to take a hard look at the crowdfunding regulations and see what we can do to make sure that everyday people have access to opportunities to build wealth. And I have to say, there are risks involved, and we should talk about the risks as well. And these are riskier investments because they are startup companies, they are newer companies. But prior to crowdfunding, you didn't even have the opportunity to weigh the risk. The government was basically saying, you're not smart enough. We don't trust you to decide whether or not this investment is good or bad. We don't trust you to do the research. We don't trust you to be able to make a decision here. We only trust people that make this certain amount in a calendar year. We only trust this. We only trust people that have this certain net wealth. And so it is, in a lot of ways, the definition of systemic oppression to systemically shut out large amounts of the population, 95% plus of the population, from being able to take advantage of an opportunity to educate themselves, to see themselves as investors, but also to potentially participate in the economic upside, and for communities of color, help to close that wealth gap, which is important.
On the topic of the potential risks, and I'm glad
Mm-hmm.
you brought that up. Recently, there's been, news of the SEC charging Robinhood with misleading customers about how it makes money. And I think in the financial industry, there are lots of financial outlets that are constantly hyping up building wealth and
Mm-hmm.
how you can make money fast, which we know is there's no such thing as making fast cash. But
Yeah.
how can these investing platforms for startups give greater access to investing while also making sure that new investors are protected?
Education is everyone's responsibility. And earlier this year, I was able to lead a group of entrepreneurs, most of whom who had actually run successful regulation crowdfunding campaigns on a range of platforms, in writing a letter to the SEC and saying, giving our opinion on the proposed changes in terms of raising the amount that that an entrepreneur could raise, but also changing the accredited investor definition. But one central piece to that letter, one central piece to the proposal that we sent was investor education and entrepreneurship education. I think you have an entity in the SEC, and again, kudos to them for moving this forward because these changes have been critical and I think are going to be positive as we move forward. Um, but they're used to speaking to certain audiences. They're used to speaking to securities lawyers. They're used to speaking to accountants and intermediaries. They're not accustomed to speaking to that 95% of the of the country that are non-accredited investors, but that 95% of the country need relevant investor education. They need timely investor education, and they need investor education that is culturally responsive and that makes sense for who they are. And so there's a gap there because as a government agency, there's not a whole lot of government agencies that do a good job of communicating communicating with their constituencies. The SEC, I think, is no different. They've got to do a better job, but also on the crowdfunding portal side, they need to do a better job of educating potential investors and educating potential entrepreneurs. One way that we see this come out is entrepreneurs sometimes go to crowdfunding because they can't raise the traditional VC way. So through an angel group or through institutional investors, or maybe they're just early on in the process and they're a little too early for an institutional VC to look at them. Maybe they're from a community of color. And so we all know that folks from communities of color don't get loans and lines of credit at the same rates that folks from the majority community get. And so maybe they've been denied that way. And so they look at something like crowdfunding, like crowd investing, as an opportunity for them. And that's part of the reason it's there. It's there to fill that access to capital gap that has existed for generations. However, what we have to be careful about is ensuring that the valuations that are set for companies, and I'm not going to tell anybody what to value your company. Valuation is, especially for an early stage company, much more art than it is science. It's honestly about what you can get someone to agree to at the time. But I think there is a habit of valuations for some of these campaigns being pushed up and pushed higher than they would be if the founder were raising from a traditional angel network or angel investor or raising in an institutional VC space. The potential risk there is if the entrepreneur, if that business isn't on a growth track that syncs with the valuation that they've set, then they have the potential of when they're raising the next round of capital, raising a down round. And then, so if they have a down round, so they raise a round of capital at a valuation that's lower than the original valuation in their regulation crowdfunding campaign, that is going to further dilute the community of investors, non accredited investors who invested in that campaign. So everyone gets diluted as entrepreneurs, as businesses raise raise sequential rounds of capital. That happens to everybody. That's expected. So you start out by owning 1% of a company potentially, and by the time they get done, maybe you own 75%, or a quarter of percent of the company. You're going to get diluted. A company raising a down round is going to dilute those first investors even farther. And so the risk there is, even if that company continues on and is successful, potentially those early investors not getting the same economic impact, not getting quite the same wealth generation that they may have gotten otherwise, had that founder been a little bit more judicious about the valuation and about the terms for those first round of investors, who should get some kind of preference because they're backing you early. And so I think we need to do a better job of educating entrepreneurs on valuation and making sure that they understand that just because that the point of valuation isn't to get the highest valuation possible, is to get something that you can track with for your next round of funding, and also getting investors to understand the length of time that it may take to actually see a liquidity event, if you're using a crowd safe, to actually see some kind of return on the investment, which for most investors and startup companies can be a number of years. Now, there are some platforms that use the crowdfunding regulation that actually have different deals. They have deals where you are helping them do purchase orders, and you get paid back on a payment schedule, et cetera. So there are some ways to bring a little bit more liquidity to the investors, non-accredited investors, with crowdfunding. But if you're doing it kind of the traditional way with a crowd safe, your money is going to be locked up for a while. And so we have to make sure that we're providing that education. There's a gap there. And I'm hoping that conversations like this will help to fill that gap in terms of education, so that everyone can get the education, make the good decisions, and again, take advantage of the great opportunity that I think is there.
Definitely. And I think that really goes back to our earlier conversation today around when you're listening to the entrepreneur's pitch and they're making their ask, really understanding the amount of money they're asking for and how
Yeah.
they've mapped that against their milestones, the way they're going to deploy the capital, the terms, equity, all of that. And you only start to really be able to create patterns in your head when you've looked at many different startups and the ways that they're raising the terms that they're raising on.
Yeah. And I definitely, two things there. One, definitely fully support entrepreneurs. We have to make sure we're doing a good job of educating people on valuation, what it means, et cetera. But also on the investor side, I always say to people when they come to me and say, hey, I'm interested in being an investor, I'm interested in being a VC, I'm interested in being an angel. I say, set up an account on a crowdfunding portal, crowdfunding platform, crowd investing platform, and treat your $50 or $100 like it's 50,000 or 100,000. So put together a list of must-haves for a company, whether those are traction must-haves, whether those are valuation must-haves, whether those are industry must-haves, and evaluate each company. Check a box on an Excel spreadsheet, or put an X in a box on an Excel spreadsheet if the company meets the standard. If they don't, then don't invest. And so by doing that, you get into the habit of looking, taking these companies through some kind of process and viewing the companies in a similar way to the way that an institutional VC or an angel investor outside of the crowdfunding space would be looking at it. And so treat these portals as not just investment opportunities, but educational opportunities. This is your opportunity to learn how investors think, to learn what to look for. And there are all kinds of rubrics, templates, et cetera, for writing up investment memos that are out there. And I definitely encourage anyone that is serious about learning the space, write up an investment memo for every potential investment you want to do on a crowdfunding platform. And after you do several of those, you'll get into this cadence, you'll get into a habit, you'll kind of know what to look for. And that information, that education is actually worth more than whatever investments that you're making, because that's going to set you up for future success as a potential investor.
That's really great advice. And I like how you've talked about this methodical nature of going through it as if you were a professional VC investor. And I think that's really how you develop confidence as an investor, because
Yeah,
you you take it seriously, you take yourself seriously, and then you go through the process as if your job depended on it.
exactly. I am I don't want to say surprised, but I'm always delighted by how responsive entrepreneurs are. I'm on crowd investing platforms and have made lots of a fair number of investments over the past couple of years. And anytime I reach out to an entrepreneur and say, "Hey, I thought this was really interesting. I thought this was really cool. Hey, I think I have a contact here. Hey, I'd like to be helpful to you with this." They're always responsive. And so you really have the opportunity to not only invest in a company, but also be kind of a loose advisor to the company and bring some additional value to those investments that you're making. Those founders appreciate the outreach and appreciate good leads, business leads, good suggestions, etc. And for you as a potential investor working to become a confident investor, it really gives you an opportunity to build your chops, to learn the lingo, to build the network that's going to bring you success in the future.
Great. So this has been super informative, very educational, I think, for anyone who is new to the space. Like, listen to this episode a couple times, let the information sink in. I think what we've really done here is empowered that new investor to think about, hey, I can be part of this process. I can be part of the change. And I can be essential to a founder, to the point of actually getting interaction with that. Even if you put in a few $100s, like, they'll still respect you as an investor.
Yeah, yeah. And this has, again, opened up an entirely new world to everyday people like me who didn't know anything about business growing up, whose families didn't come from money, etc. If you get in there, treat these investments as educational opportunities, you have an opportunity to educate yourself, see yourself as an investor, and again, potentially take advantage of the upside that's there. I think that as we are continuing to go through this pandemic, as we come out of it, I think innovation is going to be leading the way. And so I'm excited that there are crowd investing opportunities for everyday people to invest in their local businesses, to be able to help them as they're making pivots and changes based on what's allowed and not allowed in their local area. I'm glad that there are crowd investing opportunities for new innovations. There's a whole new set of problems in the world that have been created by this pandemic. And now you, as a potential investor, have the opportunity to help fund those innovations, to help support that future. And in addition to individuals being able to do it, I hope that our government will provide some support for the crowdfunding space, policy and otherwise, to encourage people to start new businesses and encourage everyday folks to become confident investors and help push our nation forward. The only way that we're going to get through this is I think by continuing to innovate. And I know the solutions are out there. We just need to get the folks the resources, and people like you that are listening have the resources, both in terms of your thought partnership, but also in terms of the funds that you might be investing.
Thank you so much. Last question, and
Yep.
this is for our Confident Investor Club members. What is the one industry, as an investor yourself, having invested in so many different companies, that you are the most bullish on for the next year?
Yeah, for the next year, it is highly regulated, can be highly profitable. I think we're going to continue to see government, whether it's local, state, federal, um, create opportunities for small businesses, programs, etc., contracting opportunities, all of those things, and start to remove some of the barriers, some of the regulatory barriers and otherwise that would have stopped people from being able to take advantage of those business opportunities previously. So if you're a business and there's an opportunity to sell to government, to contract with government, whether it's local, state, federal level, we're going to see more opportunities over the next year. We've already seen it with the stimulus packages that have happened, with the relief packages. We're going to see more relief packages sooner rather than later. And businesses that are positioned with relationships and with a product or service that can serve governments, I think are going to be in a good position to be successful, and businesses that have some kind of additional vertical that they can add to take advantage, they're going to be successful as well. And so highly regulated can be highly profitable, I think, as we go into the next year.
Awesome. Any specifics or like specific companies or verticals within that you think are especially interesting?
Well, the healthcare space is going to be the most obvious there, but I think beyond that, it's anything that's in the infrastructure space, or creating solutions around infrastructure. I think will be interesting. It's anything that's in the gov tech space, so providing a product or service or solving something within government, and then anything from a office space or networking space that can be potentially sold to government as governments respond to the new environment that we're in, and seek to use budget that's now been allocated to take advantage of some new innovations that are out there. So I think those things will have the potential to do really well over the next year. Yeah.
Cool. What do you think the
Mhm.
government's role is in supporting these new gov tech infrastructure type startups?
I think the role of government is to serve the people. And it's obvious from even before the pandemic that very often government's inefficiency, government's lack of innovation, government's inability to move forward with some things has hamstrung government in its desire to serve the people. And so this is a lot of government catching up, getting up to date, getting to a point where it can now be in some cases on par with some folks in the private sector in terms of being able to function virtually, being able to continue to deliver the products and services, the policies that people need. And so I think government's role is to seek out those innovations, it's to seek out those opportunities that are going to put it in a better position to serve everyone. And companies that are positioned to provide those services, I think, are going to do really well. Government has lagged behind in this regard for a long time, but this pandemic has forced a catch up to begin to happen. And I think there's some companies that are going to be positioned to take full advantage of it. Yeah.
Great. Well, thank you again, Brandon. This has
Yep.
been an incredible conversation, and I look forward to chatting with you more as this ecosystem evolves.
Yeah, thank you so much for having me today. Thanks so much for what you've done with the Confident Investor. Congrats on what you've built so far. Looking forward to the future. And for everybody out there, go on a platform and check it out and become a confident investor yourself.